Why 165,000 millionaires just transferred their wealth. Out of America, the stage 5 signal, 165,000 millionaires gone, not on vacation, not diversifying, gone. Their wealth extracted from American soil in near silence. No headlines, no panic, just exodus. Stage 5. Wealth strategists have a classification system. 5 stages of capital migration. Stage 1, routine. Stage 2, cautious. Stage 3, concerned. Stage 4, urgent. Stage 5 is the point of no return. The point where the wealthy don't believe it gets better. They've seen this pattern before, in other nations, in other eras, and they've made their decision. But here's what they're not telling you. What they know that you don't. Welcome to Financial Inspection, where we examine the patterns the markets don't advertise. Now, before we go further, if you've lived through a few economic cycles, if you remember when a handshake meant something, when planning actually mattered, then you understand the value of information that arrives before the crowd notices. That small button below, the subscribe button, consider it your seat at a table where serious economic analysis still exists. One click, that's all it takes. And while you're there, tell us, where are you watching this from? New York, London, Mumbai, Sao Paulo? Because what we're about to discuss, it doesn't stop at American borders. Now, let's decode what 165,000 millionaires saw that made them move their entire wealth structure, and why you need to understand it right now. In the spring of 2024, a financial advisor in Miami noticed something unusual. 3 of his wealthiest clients, within the same month, asked him the same question. Not about stock picks, not about real estate opportunities. They asked him about asset transfer protocols to Singapore and Portugal. By summer, that number had grown to 12 clients. By fall, he stopped counting. This was not an isolated incident. Across Manhattan, Los Angeles, and Chicago, wealth management firms began observing a pattern. Their highest net worth clients were not just diversifying internationally, they were systematically relocating their entire wealth structures outside American jurisdiction. The lawyers who draft trust documents noticed it. The accountants who file complex tax returns noticed it. The private bankers who move 8-figure sums noticed it. But the general public? They heard nothing. The data, when it finally surfaced, revealed something extraordinary. In a single 18-month period, 165,000 millionaires transferred their wealth out of America. Not their vacation homes, not a small percentage of their portfolios, their core wealth. The money that defined their financial identity, the capital that powered their businesses, funded their legacies, and secured their families for generations. Gone. To understand the magnitude, one must consider what 165,000 millionaires represents. This is not a few billionaires making headlines. This is a population equivalent to a mid-sized American city. Imagine if every person with significant wealth in a place like Fort Lauderdale or Salt Lake City simply decided to move their money elsewhere. The tax revenue implications alone would reshape state budgets. The investment capital that funds startups, purchases real estate, and circulates through local economies would simply evaporate. But the number itself only tells part of the story. What matters more is the acceleration. In 2010, approximately 3,000 millionaires per year engaged in significant offshore wealth transfers. Wealth strategists, the professionals who advise families with assets exceeding $50 million, began using a term that rarely appeared in polite financial circles. Stage 5. They spoke about it quietly, in private consultations, behind closed doors. It appeared in confidential memos. It surfaced in encrypted communications between legal teams coordinating complex international structures. But it was never discussed publicly, until the exodus became too large to ignore. The concept of Stage 5 comes from a framework that wealth preservation specialists developed by studying capital flight patterns throughout history. They examined what happened before the wealthy left pre-revolutionary France. They analyzed the exodus from Britain in the 1970s, when tax rates approached 90%. They documented the mass departure from Hong Kong in the years before 1997. They studied Argentina, Venezuela, and a dozen other nations where capital flight preceded economic restructuring. From these historical episodes, they constructed a 5-stage model. Each stage represented a different level of concern, a different intensity of action. Stage 1 was routine international diversification. Stage 2 involved defensive positioning. Stage 3 meant strategic repositioning of significant assets. Stage 4 represented active exit planning with formal legal structures. But Stage 5 was different. Stage 5 was the point where wealthy individuals stopped believing conditions would improve. The point where they concluded that the trajectory was irreversible. The point where they acted not out of optimization, but out of conviction that remaining meant accepting permanent disadvantage or risk. And according to the professionals who monitor these patterns, America had entered Stage 5. The evidence was not in news headlines or government reports. It was in the data points that only insiders could see. Citizenship renunciation applications at embassies had waiting lists stretching 18 months. Legal firms specializing in international trust structures had tripled their staffs. Private banks in Switzerland, Singapore, and the UAE reported American deposit growth rates unprecedented in modern times. The infrastructure of wealth exit was operating at maximum capacity, and the people using it were not panicking. They were calm, methodical, certain. They had made their decision, and they were executing it with precision. The conference room in Geneva was unremarkable. 12 wealth advisors sat around a polished table representing clients whose combined assets exceeded $40 billion. No cameras, no recordings, no public record of the meeting. This was February 2024. The topic on the agenda had one word: classification. These advisors did not deal in speculation. They managed generational wealth for families whose names appeared on buildings, whose decisions moved markets, whose capital shaped industries. And they needed a common language to discuss what they were witnessing. Not for marketing purposes, not for academic papers, for operational clarity. When a client called asking about wealth relocation, these advisors needed to know instantly what level of urgency that call represented. One of the senior strategists, a woman who had spent 30 years managing capital through 3 recessions and 2 major geopolitical shifts, presented a framework. She called it the capital migration spectrum, 5 stages, each defined by specific behaviors, measurable indicators, and historical precedents. The room went silent as she explained what each stage meant. Stage 1, she described, was invisible to most observers. It represented routine international diversification. A wealthy individual might allocate 15% of their portfolio to foreign equities. They might purchase a vacation property in southern France or a condo in Dubai. They opened accounts with international banks, not to hide anything, but to access different investment opportunities. This was standard practice. Advisors recommended it. Tax attorneys approved it. It appeared on legal documents filed with appropriate authorities. Stage 1 was optimization, nothing more. Stage 2 introduced an element of defensiveness. The client began asking questions that revealed underlying concern. They wanted dual citizenship options explored. They requested analysis of tax treaties between nations. They inquired about trust structures that provided jurisdiction flexibility. Their asset allocation shifted from 15% international to 35%. They purchased real estate in countries with favorable residency programs. Portugal's Golden Visa, Malta's citizenship by investment, Caribbean passport programs. They were not leaving yet. They were building optionality. Stage 2 was hedging against uncertainty. Stage 3 marked a psychological turning point. The wealthy individual was no longer optimizing or hedging. They were repositioning with purpose. 50 to 60% of their liquid assets moved offshore. They restructured business entities to establish genuine operational presence in foreign jurisdictions. Their children began attending international schools. Estate planning documents were rewritten to reflect multi-jurisdictional complexity. These were not temporary measures. These were architectural changes to their entire wealth structure. Stage 3 represented serious concern about the domestic environment. Stage 4 brought formalization. The client retained specialized legal teams to execute formal exit strategies. They initiated citizenship applications in their target countries. They established permanent residency. They transferred operating businesses, not just investment portfolios. They moved intellectual property to foreign holding companies. They restructured family governance to function across borders. Real estate in their home country was sold or placed in structures that minimized ongoing connection. Stage 4 was active departure in everything but final physical relocation. Then came Stage 5. The woman presenting the framework paused here because Stage 5 was not simply the next step in a progression. It represented a fundamental break. In Stage 5, the individual was not planning to return. They had concluded, based on their analysis of economic trajectory, policy direction, and institutional stability, that conditions would deteriorate rather than improve. They acted with finality. Physical relocation completed. Primary citizenship renounced in some cases. All meaningful economic ties severed. And most critically, they influenced others. Stage 5 individuals spoke to their peers, their business partners, their family networks. They explained their reasoning. They shared their research. They recommended their advisors and legal teams. Stage 5 became contagious. The room absorbed this framework in silence. Then someone asked the obvious question: which stage was America in? The woman did not hesitate. She pulled up a presentation: embassy data showing citizenship renunciation rates, private banking reports showing American deposit flows to Singapore and Switzerland, immigration attorney statistics showing investor visa applications, real estate transaction data from Miami, New York, and California showing net outflows of high-value properties purchased by foreign entities or moved into offshore structures. Legal filings for international trust establishments, corporate restructuring patterns showing American businesses establishing genuine foreign headquarters. Every indicator pointed the same direction: America had entered stage 5, not approaching it, not at risk of it. Already there, the exodus was not theoretical, it was operational, it was happening at scale, and it was accelerating. The advisors in that Geneva conference room understood what this meant. They had studied history. They knew what happened to nations when their wealthiest citizens, the ones with the most resources and the best information, concluded that remaining meant accepting permanent disadvantage. They had seen this pattern before, in other countries, in other eras, and they knew how it ended. A private equity manager in Boston received an encrypted email in October 2024. The sender was a former colleague who had relocated to Dubai 2 years earlier. The message contained no pleasantries, no casual conversation, just a single sentence. You need to understand what changed. Attached was a 40-page analysis that read like an intelligence briefing. The document did not discuss market trends or investment opportunities. It examined 4 structural factors that had convinced over 165,000 millionaires to extract their wealth from America. These were not political opinions. These were mathematical projections, legal assessments, and comparative analyses against other developed nations. The manager spent 3 hours reading it. By the end, he understood why his colleague had left. More importantly, he understood why the exodus was accelerating. The first factor was fiscal mathematics. Not tax rates alone, but the relationship between what high net worth individuals paid and what they received in return. The document presented federal debt figures that most people never examined closely. The United States carried debt exceeding $34 trillion. The debt to GDP ratio had crossed 120%. Interest payments on that debt now consumed more than $1 trillion annually, exceeding defense spending for the first time in modern history. The trajectory was clear. The debt was growing faster than the economy, and there were only 3 possible responses: dramatic spending cuts, significant economic growth, or substantial tax increases. Spending cuts faced political impossibility. Social Security, Medicare, and defense accounted for the vast majority of federal expenditures, and all 3 had powerful constituencies resisting reduction. Economic growth, while desirable, could not realistically expand fast enough to close a gap of this magnitude, which left one option: taxation. Not just income tax increases, but wealth taxes, unrealized capital gains taxes, estate tax modifications, and corporate rate adjustments. Proposals were already circulating in policy circles. Some had been formally introduced as legislation. And the wealthy understood something that most people missed. Once a government begins discussing wealth taxation seriously, the conversation rarely reverses. It escalates. But the issue went deeper than rates. It was about return on investment. A millionaire paying 40% effective tax rate in California could compare that to 0% income tax in Dubai, 8% flat tax in Hungary, or 10% in Bulgaria. The comparison was not just about the rate. It was about what came with it: infrastructure quality, legal system reliability, education system performance, business environment stability. When someone paid high taxes and received world-class infrastructure, efficient government services, and a stable business environment, they accepted the exchange. But when they paid high taxes and watched infrastructure crumble, schools decline, and bureaucratic complexity multiply, the equation broke. The wealth exodus was not about greed. It was about value perception. The second factor was regulatory architecture. The document detailed something most entrepreneurs experienced, but few could quantify. The cost of compliance had become a competitive disadvantage. A business operating in America faced regulatory requirements from federal agencies, state agencies, and local jurisdictions, often with conflicting standards. Environmental regulations, labor regulations, financial reporting requirements, data privacy rules, industry-specific licensing, each added cost, time, and legal risk. The manager read case studies of companies that had relocated headquarters to Ireland, Singapore, or Switzerland, not for tax purposes, but for regulatory clarity. They wanted to know the rules and follow them, not navigate a constantly shifting labyrinth of requirements where good faith compliance still resulted in penalties. The litigation environment compounded this issue. America had more lawyers per capita than any nation on earth. The legal system, while providing important protections, had evolved into something that created constant risk for businesses and investors. Employment lawsuits, shareholder disputes, regulatory enforcement actions, class action settlements. The wealthy individuals leaving were not trying to escape accountability. They were seeking jurisdictions where legal frameworks provided clarity rather than perpetual uncertainty, where contracts meant what they stated, where court systems functioned predictably, where doing business did not require maintaining permanent legal defense postures. The third factor involved monetary policy and currency confidence. The document presented Federal Reserve balance sheet data that told a concerning story. In 2008, the Fed held roughly $900 billion in assets. By 2024, despite attempts at reduction, that number still exceeded $7 trillion. Quantitative easing had become a permanent feature rather than an emergency measure. The dollar remained the global reserve currency, but that status was no longer guaranteed. Central banks worldwide were reducing dollar reserves as a percentage of their holdings. Trade settlements increasingly occurred in alternative currencies. China, Russia, and BRICS nations actively developed payment systems that bypassed dollar infrastructure. For wealth holders, this created a fundamental question. If the dollar's dominance eroded, what happened to dollar-denominated assets? If inflation returned and the Fed faced a choice between crushing the economy with high rates or accepting currency debasement, which path would they choose? The wealthy were not betting against America out of pessimism. They were diversifying currency exposure out of prudence. They were moving assets into hard assets, foreign currencies, and jurisdictions with more conservative monetary policies. Switzerland's constitution limited deficit spending. Singapore maintained budget surpluses. Gulf states held massive sovereign wealth funds. These were not superior nations, but they offered monetary discipline that America's fiscal situation made increasingly difficult to maintain. The fourth factor was the most difficult to quantify, but perhaps the most powerful. Institutional confidence. The wealthy individuals leaving had built their success on certain assumptions: that contracts would be enforced, that property rights were secure, that rule of law applied equally, that merit determined outcomes, that innovation was rewarded, that entrepreneurship was celebrated, and they were watching those assumptions erode. Political polarization had reached levels where institutional continuity seemed uncertain. Educational systems were producing graduates whose skills did not match global competition. Infrastructure that once symbolized American excellence was deteriorating. Social cohesion metrics showed declining trust across every demographic category. This was not about politics. Wealthy individuals across the entire political spectrum were leaving. They shared one common conclusion: the trajectory was wrong, and the mechanisms to correct it were absent. They had watched other nations experience similar institutional decay. They knew how those stories ended, and they possessed the resources to relocate before the situation deteriorated further. The manager in Boston finished reading the document and sat in silence. He finally understood. This was not a tax protest. This was not political theater. This was a calculated strategic response to structural factors that showed no signs of reversing. Stage 5 was not hyperbole, it was accurate classification. A venture capital fund in Silicon Valley held its quarterly meeting in November 2024. The agenda listed standard items: portfolio performance, new investment opportunities, fund allocation strategies. But 20 minutes into the meeting, one of the senior partners raised his hand and asked a question that derailed the entire schedule. Are we going to discuss the fact that half our limited partners are moving their domiciles? The room went quiet, because everyone knew it was true, and everyone knew what it meant. Limited partners, the wealthy individuals and institutions that provide capital to venture funds, were the lifeblood of the innovation economy. They funded the risk-taking that built technology companies, medical breakthroughs, and new industries. And they were leaving, not withdrawing from existing investments immediately, but signaling clearly that future capital commitments would flow differently. One partner had already informed the fund that his family office was restructuring to operate from Singapore. Another had established Maltese citizenship and was relocating to Lisbon. A third had moved his primary operations to Austin, then to Miami, and now was exploring Costa Rica. These were not impulsive decisions. These were strategic repositionings by people who understood capital flows. The implications for operating businesses were profound. When wealthy individuals relocated their wealth, they did not simply move money. They moved networks, expertise, and future investment appetite. A venture capital fund relied on follow-on funding rounds. Series A became Series B, which became Series C. But if the capital providers were repositioning internationally, would they continue funding American startups with the same enthusiasm? Or would they begin prioritizing investments in their new home jurisdictions? The partners around that table understood the answer. Capital follows the capital holder. If 165,000 millionaires had transferred wealth out of America, the second-order effect was that future investment would increasingly flow elsewhere. The talent implications were equally concerning. High-net-worth individuals were not the only mobile population. The engineers, executives, and entrepreneurs they employed were also reconsidering their locations. A software architect earning $400,000 annually in San Francisco paid roughly 50% in combined federal, state, and local taxes. That same architect could earn comparable income in Dubai with zero income tax, or in Singapore with a maximum rate under 25%. The mathematics were simple, but more than mathematics, these professionals watched where innovation capital was flowing. If venture funding was increasingly international, if wealthy founders were establishing companies in jurisdictions with better regulatory environments, then talent would follow. The real estate markets and traditional wealth centers were already showing strain. Manhattan, San Francisco, Los Angeles, and Chicago had experienced net outflows of high-value property transactions. Not market crashes, but persistent erosion. When millionaires sold their primary residences and did not replace them, when luxury condominiums sat longer on the market, when private clubs reported declining memberships, these were not isolated data points. They were indicators of demographic shift, and real estate was simply the visible manifestation of a deeper change. The economic activity that wealthy residents generated, the services they purchased, the businesses they patronized, the taxes they paid, all of that was contracting. Municipal and state governments were beginning to recognize the fiscal pressure. A single millionaire household might generate $150,000 to $300,000 in annual state and local tax revenue through income taxes, property taxes, sales taxes, and various fees. Multiply that by thousands of departing households, and the budget impact became severe. California had already experienced this in previous decades when aerospace and defense contractors relocated. New York had weathered financial industry contractions, but this was different. This was not one industry restructuring. This was broad-based wealth migration across all sectors simultaneously. The philanthropic sector faced its own reckoning. Wealthy individuals funded museums, universities, hospitals, and cultural institutions. When they relocated, their charitable giving often shifted to their new communities. A billionaire who moved from New York to Monaco might continue some American philanthropy, but the bulk of future giving would likely flow to European or international causes. Universities that relied on major donor commitments were watching their prospect lists shrink. Hospitals that had planned capital campaigns based on local wealthy families were reassessing feasibility. The social infrastructure that wealth had supported for generations was losing its funding base. But perhaps the most concerning second-order effect was the political feedback loop. As wealthy individuals departed, political pressure mounted to extract more revenue from those who remained. Proposals for wealth taxes, unrealized capital gains taxes, and exit taxes gained support. Yet these very proposals accelerated the exodus. The individuals considering departure in Stage 3 or Stage 4 watched these policy discussions and moved more quickly to Stage 5. The government's response to capital flight was creating more capital flight. This was not theoretical. History provided clear examples. France implemented a wealth tax in the 1980s. By 2017, an estimated 42,000 millionaires had left, and the government repealed the tax, having collected far less revenue than projected, while losing significant productive capacity. The venture capital partners in that Silicon Valley conference room understood they were facing a strategic inflection point. They could continue operating as they always had, assuming the American market would remain the global center of innovation capital. Or they could acknowledge that the geography of wealth was shifting and adapt accordingly. Some funds were already establishing offices in Singapore, Abu Dhabi, and London. Some were creating legal structures that allowed international operations with tax efficiency. Some were recruiting partners with deep networks in emerging wealth centers. For businesses across every sector, similar calculations were underway. A manufacturing company assessing where to build its next facility had to consider not just current costs, but future stability. A technology company choosing where to locate its headquarters had to evaluate regulatory environment, talent availability, and capital access. A service business, depending on wealthy clientele, had to recognize that its customer base was literally relocating to different continents. The competitive advantage that American businesses had enjoyed for decades, access to the world's deepest capital markets and wealthiest consumer base, was eroding. The strategic response framework was becoming clear to those who studied the pattern. Geographic diversification was no longer optional for serious businesses. Having operations, assets, and legal structures in multiple jurisdictions provided resilience. Entity design had to incorporate mobility. The ability to shift operations, transfer intellectual property, and restructure ownership across borders was becoming essential. Market positioning had to account for changing capital flows. If investment capital was increasingly international, then businesses needed international strategies, not American strategies with international components. Scenario planning was replacing traditional business planning. The old model assumed relative stability with predictable change. The new reality required preparing for multiple possible futures. What if capital flight accelerated further? What if tax policies became more aggressive? What if regulatory complexity increased? What if the dollar lost reserve currency status? Each scenario required different response strategies, and businesses that failed to plan for multiple possibilities would find themselves unable to adapt when conditions shifted. The meeting in Silicon Valley ended without clear resolutions, but with shared understanding. The exodus of 165,000 millionaires was not a temporary phenomenon that would reverse when political winds changed. It was a structural shift driven by factors that showed no signs of improving. The business community faced a choice. They could wait and hope for course corrections that might never come, or they could acknowledge the new reality and position themselves accordingly. The cost of early action might seem high, but the cost of delayed response when competitors had already adapted and capital had permanently relocated would be far higher. Stage 5 was not a warning. It was a description of current conditions, and the only remaining question was how long businesses would take to recognize it.